So what are put options? In this video, I'm going to give you a strong understanding of what puts are so you can begin to use them in your trading. Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. So if you're new here, consider subscribing. And today, we're going over put options. Now, if you're new to options and you haven't learned about calls yet, I would suggest checking out my video on calls first because calls are a little bit more intuitive. Now, for puts, for when you're wanting a stock to go down or you're betting that a stock is going to go down, generally you short shares to get a profit as the stock goes down. With puts, you actually buy puts because generally when you're buying puts, you are betting that the stock's going to go down. So as the stock goes down, if you're buying puts or shorting shares, you will make money on those positions. Now on the flip side, if you want a stock to go up and you want to make money as the stock goes up, you generally buy stock, or in this instance with puts, you can sell puts and those will make you money as the stock goes up. Now, the basic nuts and bolts on what put options are, just like calls, they are a contract that controls 100 shares. So when you buy a put, you are buying the right to sell 100 shares at a certain price. And then that contract you buy has an expiration date, just like calls. And then of course the contract has that price that you decide to what you want to sell your stock at. So for a quick example, if we have a stock trading at $100, we can buy a 100 put with 30 days duration on it. So what this would allow us to do is if the stock went down to, let's say, a 90, we could use this put option anytime within those 30 days to instead sell it at 100 instead of 90. And so we would have maintained some of that value. So as a quick analogy here, let's say Sarah has a car valued at $30,000 and she's worried that she's going to get in an accident, so she wants to buy insurance on it. And so she would say, I would like to buy insurance, which would be the put option, on my car valued at $30,000, which would be the strike price of the option. And so Jack here, being in car insurance, he says, okay, I will sell you that car insurance or that put option for $1,000, which would be the option premium or the cost of the put for the next 6 months, which would be the duration of the put option contract. And so Sarah here would then pay him that $1,000, and she would then, over the next 6 months, if she got in a car accident, she would be able to use her put option to be able to sell her car at $30,000. So to give a quick summary of this situation, again, Sarah is buying a put and Jack would be selling a put. And then the put would be the car insurance, with this strike price being that $30,000 value on the car. And then the premium or the cost of the put option would be $1,000. And then the expiration would be 6 months. Over those next 6 months, if the car got damaged or in a car accident, Sarah could exercise her put option or in her insurance on the car and then sell her car for that $30,000 or collect the difference in damages that the car had. If nothing happened over the next 6 months, Sarah would just be out the $1,000 that she paid for the put option, but she still would have protected the potential for that loss of value in her car. So as a real example, let's say you own 100 shares of a stock trading at $100 and you're worried that the stock is going to go down. So you want to protect those gains you've already made and make sure you don't lose money as the stock goes down. So you are going to buy a $100 put. And so here that $100 put costs, let's say, $1 per share. Now options are always done on per share basis, but because an option always controls 100 shares, you always just times the price or the cost of the option times 100. So if you see that an option costs $1, it really means it costs $100. And then we'll get the option with 30 days till expiration. Now, if the stock goes all the way down to 90, like we maybe thought, we could then exercise this option and sell our shares at $100, even though the current market value is 90. This put allows us to sell our shares for no loss, even though the current market value is well below where we're actually selling. If the stock just decided to go up and never goes below 100, we would then not have to use our option here because our position would be going up in value. Now we would still be out the $100 that it cost us to buy that put option, but over those 30 days, if the stock went down, we were still able to protect our position so we didn't actually lose any money. So a big thing about options is you don't actually have to have shares to be trading options. Options are essentially a market of their own. And so if you want to short a stock, like I said in the beginning, you can just buy a put and then sell the put back to make a profit. You don't have to exercise the put option to then sell your shares to protect a position. You can just buy a put for $100 and then sell it back when it's worth maybe $1,000. So walking through an example of that, let's say we have this same stock trading at $100. And now we think again that the stock is going to go down to 90. So we are going to buy that 100 put for $1 a share. And that's going to equate to $100. And then we're going to have 30 days duration on this put option. And so that gives us 30 days for the stock to go down in our direction and our put option to increase in value. With buying this put, as the stock goes down, our position will get greater and greater value, but we will also have a portion where our option won't make any money, even though it's below the strike price. And that's because we have to pay the option premium for the put option. To calculate the break even of our option, all we need to do is take the strike price of our option, which is 100, and then minus the cost of our put, which is 1. And so that equals 99. And that is the point where our option will hit break even and then start to become profitable at exercise value. To give you a quick idea of what that looks like, here we have a put option profit graph. And so here's the current trading value of the stock at 100, and then that break even price of 99 that we calculated. So anywhere to the right of our strike price is our max loss. So if the stock goes up, we'll lose that $100 we spent because the stock didn't go down in the direction of our put. But as the stock begins to go down, our option begins to go up in expiration value. So if we decided to exercise the option at any of these prices, it would be going higher and higher as the stock went down. So as you can see, as it goes lower and lower, it begins to rapidly gain value. And with that break even price of once it goes past 99, we've made a profitable trade. And understanding that area between 100 and 99, it still has a little bit of value because it is below your strike price, but the exercise value isn't overcompensating for the cost of the put. So it really has to get past that 99 or it be worth it. So just like calls, not all puts are the exact same price. So if I wanted to buy a $100 put, that would be a lot cheaper than a put at $110 if the stock was currently trading at 100. And on the other side of that, a $90 put would be way cheaper than a $100 or even a $110 put. And that is because intrinsic value have two different types of value assigned to them. They have intrinsic value and extrinsic value. Now, think of intrinsic value like real money value. What does this put do for me when I actually use it? So when I exercise this option, will I actually make money from it? So if we have a stock trading at 100 and I use a put to sell shares at $110, that has real value because I'm selling those shares at $10 higher than the current market value. And so that would give that option intrinsic value. And to show you how to quickly calculate the intrinsic value of any option that we have, we want to take the strike price of our put, which let's just say we have a put of 110, and then minus the current value of the market. And so that would be $100. And so that would equal 10. And then because all options control 100 shares, we have to time this value by 100. And so that gives us 1,000. So the intrinsic value of a $110 put when the current value of the stock is trading at 100 would be $1,000. And because this put option has intrinsic value, it is called an in the money option or ITM for short. And so any option that has intrinsic value is in the money. An easy way to remember this is in the money starts with an I and intrinsic value also starts with an I. And then so on the flip side, the $90 options are called out of the money. And these don't have any intrinsic value because if you exercise the put at 90 when the stock was currently trading at 100, you would be selling below market value and actually locking in a loss, which you would definitely not want to be doing. And the only value these have are that extrinsic value. Extrinsic value is essentially the compensation that the option seller wants for selling you this option. Because they're putting themselves at a risk of giving you the right to sell them shares at a certain price, they're going to want compensation for that. And then the $100 strike, or the strike price at the current market value, is called at the money. And these don't have any intrinsic value as well, but they do have extrinsic value. Now to give you a quick example of the price difference between these options, and in the money could be about $1,400. And then an at the money could be much lower at $350, and then an out of the money would be even lower at $150. Now these aren't extremely accurate prices of options, but it shows you that once you go in the money, the price of a put option skyrockets. And then when you go out of the money, it goes down very rapidly. Because out of the money options have no real value, people aren't going to pay that much for them. All people are paying for is the bet that it's going to have real value at some point. And as the puts go further and further down, it's less and less likely for the put option to actually get intrinsic value at some point. If you have a $90 put, the stock has to go down 10% for you to even get just to your strike price of your stock. That doesn't even mean you've hit break even yet, let alone become profitable. So you're not going to want to pay that much money for that option because the likelihood of you becoming profitable with that option is very slim. And this is why in the money options are so expensive to begin with, because they already have that intrinsic value. And so it's likely that they become profitable because they don't have to move very far for you to begin making a profit. Another reason why they cost so much is because the seller has to take into account that intrinsic value it already has. Someone isn't going to sell you a put that is trading way above market value without taking into consideration the current value if you exercised it right now. Here's a graph to show you how option values increase based on intrinsic value and extrinsic value. So as the stock goes up into further and further into the money, you can see that the total value of the option goes up, and as it goes out of the money, the option value goes down. And then right at the money is when intrinsic value becomes a factor. Now you'll notice that extrinsic value is actually highest with at the money options. And that is because the people selling those options want more and more compensation. It is more likely an option that they sell you that's at the money becomes profitable and gains intrinsic value, which actually isn't good for them. So to show you what this actually looks like on an actual trading platform, here is a options chain of Apple stock. And an options chain shows you all the options for that stock. And so on this chain right here, this is the puts portion of the options chain right here. You can see over here we have the strike price, and here's all the selected strike prices that we have. And now there are more than this. This is just all that the window is showing at the time. And then you can see the bid and ask, which is essentially the trading price of the put options. And then here we have columns that show the extrinsic and the intrinsic value. And then I put this chart over here again to hopefully illustrate that for you. And so Apple at the time of this picture is currently trading at $174.80. So at the money is roughly $175. And so this options chain shows you where out of the money and in the money is based on the background color. So in the money is this purple area or this section of the chart, and then out of the money is this black section of the chart. And then between those would be considered at the money right here. And then to start off with out of the money options, you can see that they have zero extrinsic value. None of these strike prices over here that are below 175. Over here you can see that we have 172.5 all the way to 157.5. None of those have intrinsic value because they are below the trading price of the stock. And a put, buying a put gives you the right to sell at the strike price. So you're not going to want to sell at 160 when the current trading price is 175. That's going to cause you to lose $15 per share when it's not needed to. So that's why these have zero intrinsic value. And then you can see in the intrinsic value column, it increases as you go closer and closer to at the money, or where it changes from black to purple. All these numbers are times 100 because it's in a per share value. So this extrinsic value of 97 right here actually means $97. Over here in the bid and ask column, this is where you can see the price that the buyers and sellers are willing to pay. And so currently you can see that that is at $94 and $100, with the mid price being about that $97 or the actual value of this option. And so you would still be able to buy this option at that $97 that the extrinsic value shows. Now, if we look at the extrinsic value for in the money as well, you can see that it also increases as you go closest to at the money. And so just like the chart over here shows, the extrinsic value increases as you go closer and closer to the at the money strike. And so this 175 put right here is the closest to the at the money. And so that is why this one right here has the highest extrinsic value. Now, once we hit the at the money, you can see these puts start gaining intrinsic value. And as they go further and further, the intrinsic value goes higher and higher because they are gaining that real value of when you actually exercise the put, you can sell the stock for a higher price than what it is currently trading at. And so if we look at the strike price of 185, you can see that the intrinsic value is exactly $10.20 away from the actual trading price of the stock, because it's 175, so that's $10 away, and then it's 80 cents. And so that is the 20 cents. And you can see that this put here is trading at almost the exact intrinsic value of that option, except it has a tiny bit of extrinsic value, which increases the cost of the put by a little bit. If we would have closed that window in the options chain, we would have brought up this. And this is the zoomed out version of the options chain showing you every expiration that there is. And so in this white box over here, you can see all the different expiration durations, with this one up here showing that this options chain, or all the puts and calls in this options chain, have 0 days till expiration, meaning they expire today. And then all the way down here, this one, it has 35 days till expiration. And then it gives you the date on the side of exactly what they are. There are some yellow ones and some gray ones. And the ones that are yellow that say weeklies are options that are added in. Because generally options only expire every third week of the month, or are called monthlies, you can see these gray ones are about 30 days apart because those are monthlies. And then as we get closer to actual expiration, the larger stocks, such as Apple in this case, add more options because they are highly traded. And so here you can see that the weeklies start to get added about 2 months out, and that's adds in all these extra options chains, which gives you a lot more variety of options to use when you are trading. Now, all these options aren't going to cost the same. Someone who is going to buy an option with 7 days to go is going to want to pay a lot less than someone that's buying an option that has 200 days to go. And the people selling that are going to want more money as well. And so the options that are further out in time are going to cost more money. And these options actually then decrease in value over time, or they have that time value decrease. And that is part of that extrinsic value. And so that is called time decay. And in the options world, that is called theta decay. And theta decay doesn't decay at the same rate at all times. As you get closer and closer to the actual expiration of the option, the rate at which the option's time value decreases goes faster and faster. And so it's really important to keep in mind that as you buy options at different times, they are going to lose value based on how far out they are from their expiration date, with that time value changing all the time and getting faster and faster as they get closer and closer. So quite often with options, it's good to give yourself more time than you think, so your option isn't losing value faster and faster as time goes by when you're just waiting for a stock to move in your direction. Keep in mind that the value of an option is always changing. Just like how the value of a stock is always changing, the option is always changing as well. And theta is only one of the 4 major variables that go into calculating how the options are valued. So if you're interested in what those are called Greeks, and I will have a video that talks about all of those and dives in further about how options work. Now, if you're new to the channel, make sure to subscribe, and if you have any comments or questions on this video, make sure to ask them in the comment section below.